Hello and welcome to this edition of Let's Talk Money with me, Vivek Law. Life can be uncertain and we see that more and more around us. And while we can never compensate for the emotional trauma that comes with death, we can certainly try and take care of the financial needs of those who we leave behind. Today, we will talk about life insurance and why it is important for you. Most people strive to save enough money to take care of their family. But all plans go haywire when an unexpected event occurs. This is where life insurance plays an important role. Insurance is needed to ensure that everything goes as planned, even if the earning member dies suddenly. Let's see in this special report on life insurance.
Life is uncertain. It is important to ask yourself a question. What if something happens to me? Will my family be able to pay off the home loan? What about the education of my children? Do I have enough saving to replace future income? This is why life insurance should be an integral part of your financial planning. But still, India is grossly underinsured. Life insurance penetration was just 3.1% in 2013 and 14. The insurance penetration increased from 2.15% in 2001 to 4.60% in 2009. Experts say you should buy a cover of at least 10 times of your annual salary to ensure a steady flow of income.
You should have at least 10 times of your annual income as your life insurance cover. That's like a base rule, and even if we compare the current value of insurance Indians hold relative to this rule, we are grossly underinsured.
For pure protection need, you should buy a term cover as it is the cheapest plan. For investment purpose, there are plans ranging from money-back plans to unit-linked plans. Term plans are the cheapest plan. For a 35-year-old, an annual premium of 10,830 can buy a term insurance cover of Rs 1 crore for a term of 25 years. In endowment and unit-linked plans, the cover is generally restricted to 10 to 20 times of the premium paid.
The one that's most effective for covering a large value of protection need at a smaller price are term plans. And we've seen them become increasingly affordable. We've also seen them being increasingly understood by consumers, and therefore we're seeing more people buy term today than we had in the past. Companies have also progressed this to make online offerings available. Now, the challenge with that is that only people who understand and feel competent to make that decision by themselves go and buy online.
Once you decide on what to buy, you can buy the policy online. There are some ULIPs that are available online whose costs are less than that of mutual funds. The cost per annum in online unit-linked plans work out to be between 1.29% to 2%. The charges in ULIPs that are bought from agents vary between 2.5 to 4%. Insurance is the foundation of financial planning, so go ahead and buy the right cover for your family to secure their future.
So you've seen through our report on insurance and got an idea why insurance is important. To discuss more about life insurance, I have with me now Vinay Saha, who's the Executive Director at LIC, joining me. Thank you very much, Mr. Saha, for coming by here on Let's Talk Money. My first question to you, sir, are you seeing some kind of an increase in the number of people who are looking at covering themselves, insuring themselves more adequately, because we continue as a country to have such low levels of insurance?
I am afraid not. In the Indian context, insurance, again, I would say, is not being bought. It is being sold, number one. Number two, the adequacy part of it, the concept of insurance, what we call in insurance terms as a human life value, that is fairly not known to many people, and I would say that most of the country, wherever insurance has been taken, is underinsured.
One of the biggest concerns, Mr. Saha, over the last few years regarding insurance was the fact that the rates of commission were extremely high, and when consumers got to know about this, they felt extremely betrayed. But in the last 2 or 3 years, we've seen a lot of regulatory changes. We have seen a lot of cuts in the commissions, for example. Can you give us some sense about the extent of how much the insurance policy has become cheaper?
See, you're right. We had a very major change in the regulations as far as the products are concerned in the year 2013-14. Beyond 1st January 2014, all new products have come. Therein, capping of the commission was one of the major factors which directly goes on to the pricing of the product. The products must have become cheaper by, I would say, if not more, by about 10 to 15% because of that.
And are you seeing a trend where people are actually buying more the term cover, which is what we call the plain vanilla insurance? Because traditionally, again, endowment products like your money back plans, etc., were extremely popular with people. And while they were good investment plans for them, though having said that, the returns clearly did not compare with other equity-linked products. But even so, people bought these products because they were of the view that they get back a certain amount of money periodically. But term cover, which is where you can actually enhance your real insurance cover, weren't really sold very well. Are you seeing some kind of a change in that ratio?
Of late, say last 4 or 5 years, there has been some increase as far as the term covers are concerned, but I would not say that that has increased substantially. Still, people go in for endowment type of a product, people go in for ULIPs, people go in for any instrument which gives them liquidity also, return also.
Would you say, Mr. Shah, that the first policy any consumer should buy, any individual should buy, should actually be a term cover?
I would say that insurance should be bought right when a person starts earning. And at that point of time, yes, as you said, he can start by a term cover, which can be increased, taken up substantially when his income increases. And then some sort of a upsell and a cross-sell can be there later on in the later stages of his life.
One of the other risks that we also run is if we end up living too long, isn't it, Mr. Shah? And I think that is where planning for your retirement, planning for your years after you've stopped earning, and now that period is only increasing, isn't it, with life expectancy rising so significantly. Where does insurance fit into that? I mean, do the pension plans work out? Because we've got so many plans now out there in the market. We've also got the NPS. So for insurance companies, are you able to customize or innovate in the pension space?
As you very rightly said, when I had joined insurance about 20, 25, 30 years back, that time we were taught that insurance is basically the fear of dying too early. And now that has changed to living too long. So that is where the pensions fit in. And again, looking to today's scenario, the NPS is there. Government also has been bringing in interventions by way of Varisht Pension Bima Yojana and other schemes. Of late, the Atal Pension Yojana for the BPL people mainly. As far as insurance companies are concerned, every company is venturing into this space. We already have an immediate annuity plan also, which the policyholders can go in for. We do devise pension plans also, but then again, it is now basically shifted from a defined pension to a defined contribution concept.
Are you still, you and other insurance companies, still being able to attract people with some of the health-related products, because there were these critical illness riders which used to be there on life insurance policies? Is there also the health benefit that you can actually get through riders on your insurance policy?
In our country, basically health mainly still is linked to a Mediclaim sort of a policy which is being sold by general insurance. Life companies do have health products. We have been having one product which is fairly popular, but I'm afraid that if we see as a share part of it, 95% of the business goes to general insurance companies by way of Mediclaim. So life insurance companies taken together won't have a share of more than about 4%, 4.5%.
Are you increasingly seeing, Mr. Shah, more and more people buying online and therefore paying even lesser commissions? You did mention earlier that commissions have come down, but if you go through the online route, you probably pay very, very little, isn't it? Are you seeing some traction building on that side?
Yeah, online commission, again, I mean that cost part, the product cost wise, it goes down by another 20% in some products. So online is becoming, but then again, total industry as a whole, I don't have figures. For LIC, the online is, the product is there, a term insurance product is there, whereby after the launch, we would say that we have been fairly successful in urban areas. And I'm told, from what I understand, is that one or two private companies are doing fairly well in this segment. But we need to do more as far as online selling is concerned.
The big question that always comes in the mind of a consumer, Mr. Shah, is how much insurance should I buy? Now, you are a product manufacturer, you represent a product manufacturer, the biggest in India. But if you were to put on the hat of someone who's going to be telling an individual how much insurance do you really need, what is your formula? I've heard this 10 times of your salary income from most experts. Do you have the same formula in mind to give an advice to our viewers?
I had mentioned the term human life value earlier. Basically, the insurance coverage should be your current value of your future earnings, in short. 10 times you said no. LIC is very readily giving up to 25 times the annual income as the coverage, and that is something which individuals should have. This also depends on at what age you are looking at this insurance. Earlier stages, we would go up to even 30 times of the annual income as a cover to the policyholder.
Thank you very much, Mr. Shah, for coming by and sharing your thoughts with our viewers here on India Today. Thank you once again. We are talking about insurance and how it is so very important for you to get adequately insured. Also joining me now is Yashish Dahiya, who is the CEO at PolicyBazaar.com. Thanks very much, Yashish, for coming by.
Thank you.
Also with us now to ask her question is Varsha John. Hi Varsha, it's a pleasure talking to you. You have such amazing goals. You want to set up an old age home at 50. It's really wonderful talking to you.
Hi Vivek, thank you so much.
And how are you planning to go about this? You've bought one insurance policy is what you've written to us.
Yes, yes. Vivek, to be very honest, I had in my mindset that, you know, insurance policies and all these stuffs are not really helping out. However, last year when I just had an interaction with one of my known, so she told me about this policy wherein, you know, by the time I reach an age of 50, I will be, since I am into private sector, so by age of 50, I will not be eligible for any kind of pension scheme or something. So she said that if you invest into this post 50, every month you will be eligible for getting 15K to 16K per month. Like you can consider it as a pension amount like that. So this is how this policy, I have just taken a policy in my ever life from life insurance.
And this is the only investment you have?
See, exactly. To be very honest, this is the only investment in terms of insurance and all. Or no other investments I have done ever in my life.
You know, Varsha, the big question to ask is whether this 15 or 16,000 will be enough 18 years down the line when you're going to be 50.
Not exactly. Not exactly.
So I have Yashish with me. Just listen in. He's going to tell you whether you've done the right thing and what can you do more. She is paying a fair amount of premium on this. She's going to get 10 or 15,000. Her goal is very set.
Yeah.
She wants to open an old age home at 50. 18 years is the investment period.
Yeah. So she's got an 18-20 year investment period. Varsha, my view is that beyond a 10-year period, most fixed payout sort of plans will not keep up with inflation.
So she has to get out of this particular scheme. She can withdraw right now.
I think once she's already in the plan, it is not advisable to get out of it. What I would suggest is complete 3 to 5 years with the plan, convert it into what they call a paid up policy where you would get a quarter of the benefits or so, but you would not get all the benefits. So maybe it's a 20-year plan and you complete 5 years. So you complete the base lock-in period. And then you convert it into a paid-up policy. Do not ever get out of a traditional policy, because if you get out, you lose a huge amount of money. So see, about 50–60% of the people cancel their policy within the first 3 or 5 years. And in that situation, they lose out a lot of money. So I would not advise getting out of the policy. I would say complete 3 to 5 years, but start investing alongside into mutual funds, specifically if your time horizon is longer than 10 years.
Oh, okay.
Okay, Varsha, thank you very much, and I wish you all the very best.
Thanks,
All
Vivek.
right. Yashish, one question that I had for you is that, for someone like Varsha, it's a dilemma for everybody, right? That how do you actually go about picking the right mutual fund scheme for yourself? What are the 3 or 4 parameters that I need to look at before deciding on one insurance company versus the other?
I think if you're looking at, there are 2 elements. If you're looking at a long-term investment plan, if you're sticking to that part, I think one element is, if you look at the funds, you got to see how have they historically outperformed the market. You don't want to pick up funds which have too much erratic performance. You want to pick up the funds which are fairly conservative, because you are investing for a conservative purpose. But the ones that are able to, it is still possible in India to, on a consistent basis, beat the market, primarily by avoiding some of the stocks which some of the large funds are forced to invest in. So I think seeing something that is able to beat the market by 1–2% over a consistent period, the last 3 to 5 years, makes some sense there. The second thing one should look at is the cost of the charges that are going into any particular plan. And the way to look at it is essentially something that I call total in place cost, which is your loss of yield. So if the market's going to give you 14%, or if that fund earns 14%, then including all the charges, how much are you going to get? If the fund makes 14% and you have a total in place cost of 2.25%, then you'll make 11.75%. So you need to count that, because that is a given, that cost will come. And today, as I said, there are certain unit-linked products that are able to operate, as far as my calculation goes, down to about 1.25% or so, because they have about a 1.35% fund management charge.
Charges have come down.
Charges have come down dramatically. And one shouldn't, I think it's very difficult for an individual to get into the calculation of, okay, how much is the premium allocation charge, how much is, just club all of them together and calculate what is the total in place cost. I think these 2 parameters, one is non-erratic performance, able to keep up with the market at least, or maybe beat it. And there are quite a few funds that are able to consistently do 1–2% above market. And the second part being, it has to be low cost, because the costs are a given. If something has a 3% cost or a 2.5% cost, that's going to go away, and those are going to be. So just think about it. If you're investing 1 lakh rupees every year for 20 years, that's going to become about 40–50 lakh rupees at the end of this period. And if you have a 2–3% cost on that, you would be paying about 1 lakh rupees per year. So don't get fussed about each individual charge. The overall cost of performance is quite high.
We've got an SMS that has come in from Mandeep Kaur. She says she has 2 policies. The total sum assured is 10 lakh rupees. She says, I'm worried for my son's future. He is 4 years old. How should I plan for his future? And please suggest, what should I do? You've had a look at the 2 policies that she has, Yashish. Should she be worried?
I think she should go in for unit-linked child plans. None of these are unit-linked child plan. She should go for unit-linked child plans, primarily because she'll get the best of the market rise. Over a 14-year period, it should give her a fairly stable return, as it has in the past. On the second hand, she must insist on something known as a waiver of premium facility. So the advantage of a child plan is that in case something unfortunate happens, then that amount is still protected for that child when they turn about 18. And if you have the unit-linked part of it, then by the recent IRDA guidelines, the cost is definitely kept at below 2.25%. And you could go for plans which have much lower cost than that as well. But if you insist on the waiver of premium facility, what that means is if any unfortunate event happens and you cannot pay the premiums any longer, you would not need to. And the child would still get that amount, which is the whole objective of creating this protective pool. And given the time frame she has, I would advise that. I think the current plans she has would give inadequate returns compared to what she could get. I would not, again, suggest cancelling these. I would suggest continue them till the lock-in period. then convert them into paid up policies and stay with that fund, and whatever she gets out of it is.
Do you think she should also get herself a life cover, a term cover?
She should definitely get herself a life cover, which would be roughly about 10 times her income, 10 times her gross income, or maybe 15 times her net income post taxes. She must also get a health cover. If she has not done so, it's very important that she gets a health cover. Given her age, I think going in for a critical illness sort of plan might also be very handy.
Thank you very much, Yashish, for coming by and taking questions of our viewers. Well, that's all the time we have on this edition of Let's Talk Money. Next week, we will discuss investments in gold. So if you have any query related to gold, then do write into us at letstalkmoney@aajtak.com. Goodbye. Have a good weekend.